We're now nearing the end of Introduction to Financial Planning as we're approaching the last few concepts, which is planning for retirement. After this course, there's going to be a course on estate planning. And after that, we're pretty much going to show you how to put all of these tools together to create one financial plan. But this is pretty much nearing the end. This is one of the last three courses that we're going to have. With that being said, let's get started. I'm going to start with definitions on Social Security. Although if you're like early 30s and under, the likelihood of you getting Social Security for retirement is like slim to none. So this isn't really dedicated towards you, but if you still want to understand the concepts, there's no reason why you shouldn't at least know some of this stuff. In order to qualify for Social Security, you have to build up a number of credits. And these credits total to 40 credits to be able to qualify. And to receive one credit, every $870 of your FICA tax that's dedicated towards Social Security adds up to your 40 credits. And you can receive no more than four credits a year. At the age of 67, now you're eligible to qualify for full benefits of Social Security, which usually supplements on average 42% of your income. If you earn less than the average, you're typically going to earn more than 45% of supplemental income, while if you're a high wage earner, by the time that you retire, you're going to earn a lot less than 42% of your income. There's different type of retirement plans that you can invest in. Employer-sponsored retirement plans are the ones that people are going to be most familiar with. So I'm going to go over a couple of these concepts. I'm also going to dwell into individual retirement accounts and self-employed retirement accounts as well. But here are some fundamental definitions that you should know about employee-sponsored retirement plans. First one is defined benefit plan, which guarantees a specific income when you retire based on your years of employment and your salary. Basically what that means, if you're making $100,000 a year and you work for 30 years, your employer can guarantee you $40,000, $50,000 of income after you retire until the time that you pass on. Being vested means that you're guaranteed a claim to a portion of the money in a retirement account, even if you leave the company early. And also another term that you want to familiarize yourself with is defined contribution plan, which specifies the allowance of what you and or your employer can contribute to your retirement plan. The positives of a defined contribution plan is the taxes are deferred, the employer could potentially contribute, which basically means that's like adding income to what is not put on your income. Or your gross income for taxes. And you have a little bit of freedom in selecting where you want your investments to go. You can put them in mutual funds, stocks, bonds, so on and so forth. Decisions. Sometimes you have to ask yourself these questions. Which retirement plan is right for you? A good place to start, again, because it's the most popular that most people deal with, are employer retirement accounts. Ask your employer about the retirement accounts. Most of the time when you're applying for a job, they're going to let you know right away whether or not they offer 401ks or health benefits or anything of that nature. How much do you contribute? There's a maximum level that's put on all retirement accounts that allow you to put on all retirement accounts simply because it is a tax deferment in most cases. The amount that you want to contribute depends on the duration of work until your retirement. Do you have 10 years until retirement, or do you have 40 years until your retirement? And you also want to take into account your current cash flows. How much money are you bringing in? Does it adequately cover your outflows? And what's your future expectations on your lifestyle? Do you plan on traveling to 60 countries when you retire? Or do you plan on staying stationary, living in your house that's paid off after you paid off your 30-year mortgage, and just going around local museums or going a couple states away? And how to invest your contributions. One thing that you shouldn't really worry about, especially if you're investing in a defined contribution plan, is how it's going to affect your taxes. Most of the plans are tax deferred, so you don't really have to worry about that. Like any other investment, what you want to focus on is a diversified portfolio, which is the safest option. The easiest way to diversify is through mutual fund investments in stocks or bonds. But having a good mix between growth stocks, junk bonds, high dividend stocks, or low risk investments like treasury bonds is also a good mix. So within anything, what you're trying to do is create a diversified portfolio. The paradox of investing, I do want to stress this point, and I'm not giving you investment advice. I'm simply educating on common mistakes. If you're 10 years away from retirement, and you have failed to invest up until that point, while it might seem like a good idea to invest in a stock that claims to guarantee 35% growth, when you're nearing retirement like that, the best idea is not to invest in risky things. Although it may seem like a good idea because you're recovering from the losses of the previous 20, 30 years that you weren't investing, it's safer to stick with less risky stocks. While if you're younger, you would think, well, over a period of time with the time value concepts and compounding, you would essentially be better off investing in low risk stocks because it's going to accumulate over time. But when you're younger, it could be a good idea to invest in more risky things while maintaining a good mix of low risk and high dividend or high growth stocks as well. So that's the paradox there. When you're younger, you want to do more high risk, although it would seem like it would be contradictory to do that. It's actually more beneficial to you long term. Here's a quick example of a savings in a retirement account. How you would calculate that, again, is using time value concepts. In this particular equation, savings in your retirement account, when you're giving annual contributions, is the annual contribution multiplied by the future value interest factor of an annuity. The example we're going to use is you're going to put $5,000 into an account over the next 40 years that accumulates 5% interest. Your future value interest factor of that annuity is going to be 120.797, and you're going to multiply that by 5,000, which again is your annual contribution. And your total savings over the course of the next 40 years would be $724,782. Let's go a little bit further with this. Let's say that you want to invest $700,000 in a high yield bond that gives you 10% coupon rate over the next 20 years. So you would technically receive $70,000 a year in income from the coupon rates over the next 20 years without even tapping into that $700,000 that you've accumulated over the past 40 years from investing. Here are the types of employer retirement plans that you have. The first one, the most common one that people hear of, is a 401k plan, which is defined as a plan that allows you to contribute up to $17,500 on a pre-tax basis. There's a plethora of mixes between 401ks that range between an employee contributing everything to an employer contributing a lot, if not most, to an employer's retirement account. And a lot of people are working at larger nonprofit organizations now, like a hospital, for instance. The equivalent of a 401k in a nonprofit industry is a 403b plan. So again, the same contributions are applied. And the penalties for pulling from either one of them is up to 10% withdrawn, plus the tax rate of your income at that particular period of time, your marginal income when you pull the money out. Anytime before the time that you reach 59 and a half years of age. Some more type of plans are the Simplified Employed Plan, or the SEP, which is used by small firms with employees under 10 people or by self-employed people. The employees are not allowed to contribute, and the employer can contribute up to 25% of the employee's annual income. A simple plan or savings incentive match plan for employees. It's a defined contribution plan, which is usually for firms with fewer than 100 employees. An employee can contribute up to a certain amount if they are over 50, which can apply as a catch-up amount. You also have profit sharing, defined as a contribution plan where the employer can contribute to an account based on a profit formula that the company has. So let's say that the company has $200 million of extra profit that they decide that they want to put into a retirement account for their employees because they weren't anticipating that particular type of revenue. There's also the Employee Stock Ownership Plan, or the ESOP. This is where an employer contributes some of its own stock to an employee's retirement account. Interesting thing about employee stock ownership plans, I'm going to get into this in a lot of depth in other courses, not the Introduction to Financial Planning course. It's not appropriate for this one. But a lot of organizations and schools of thoughts that think that employees should own companies as their owners phase out of the company or decide to retire. One of the best options that they have for taking over ownership of a company and having an employee managed business is to start to implement employee stock ownership plans. You also have a rollover IRA, which is an individual retirement account that allows you to transfer your company retirement plan tax-free while avoiding penalties and taxes. Again, tax-free. This is in the event that you decide to leave your company and you want to take the money that you're left over, like vested, which was the initial definition that we went into the first slide. You take this money and you put it in your own individual account for retirement because you've left the company. These are the two different types of, there's other types, but these are the two main types of self-employed retirement accounts. The Keogh Plan, which allows you, the self-employed, to contribute up to 25% of their pre-tax income to a retirement account. And as mentioned before, the SEP is also a retirement account that self-employed people can use, but it's also used for companies that have typically less than 10 employees. These are the individual retirement accounts. A traditional IRA, which is an individual retirement account that allows you to contribute pre-tax dollars up to a specified amount, and taxes are deferred unless your income is extremely high. And you also have a Roth IRA where you're taxed on your income at the time of the contribution. So the difference between a Roth IRA and a traditional IRA is the time that you're taxed. A traditional IRA, you're taxed after you retire and withdraw the money, and a Roth IRA, you're taxed at the time of contributing to your retirement account. Now, in deciding of whether or not one is more valuable to you than the other, it depends on your marginal income at the time that you're contributing and your marginal income at the time that you're withdrawing for retirement. So at any given point in time, it could be more profitable for you long-term to do a Roth IRA because your marginal tax income might be cheaper now than it is when you retire. Or the traditional IRA may be better because your marginal income when you retire is going to be substantially less than it is at the time that you're working, which in more cases than not, your marginal income at the time you retire is going to be much less than the time when you were working. The relationships of the different variables for determining your retirement plan, as with most of the time value concepts that we went over, the three main are the amount saved, noun, the years of savings, or the amount of time in which you're saving, whether it's 10 years, 20 years, 30 years, and your annual return or the interest that you're earning or the yield that you're earning on your retirement. So if you're getting 2% annual return as opposed to 10% annual return, you're getting a lot less when your annual return's 2%. And the value of your money is going to be worth a lot more if you're investing 30 years as opposed to 10 years if all things remain constant. And the amount that you save now, and if you save less, obviously, unless your interest rates are substantially higher than if you're investing more, the amount that you saved is going to accumulate to a higher number over a long period of time. With that being said, this is the end of planning for your retirement. Again, we're nearing the end. I know a lot of you are excited that we're nearing the end of this course on Introduction to Financial Planning. The next video is going to be on estate planning, and after that, again, we're going to bring it all together on integrating these concepts to develop a working financial plan that's right for you.